In January of 2019, a company that rented desks and shared coffee machines was worth $47 billion. That made it, on paper, more valuable than Ford, more valuable than FedEx, more valuable than most of the airlines flying its own executives around the world to raise more money. 4 years later, that same company filed for bankruptcy. Its stock, once projected to make its founder one of the richest self-made men in America, was worth 84 cents a share. The whole company, the brand, the leases, the furniture, all of it, was valued at $44 million, not billion, million. The easy explanation is sitting right there, and almost everyone reaches for it. The pandemic emptied out office buildings, and WeWork, a company that rented office space, died because nobody needed office space anymore. It's tidy, it's convenient, and it's wrong, or at least it's dangerously incomplete, because it hides the actual story. WeWork's collapse was set in motion nearly a decade before a single lockdown order was signed. It was built into the contracts the company chose to sign, into the incentives that rewarded growth over survival, and into a governance structure that let one man run a multi-billion-dollar company as if it were his personal bank account. The pandemic didn't kill WeWork. It walked into a building that was already on fire. WeWork started in 2010, when Adam Neumann and Miguel McKelvey opened their first shared office space in Soho, Manhattan, in the spring of 2011. The pitch was simple, and at the time, genuinely useful. Freelancers, startups, and small teams didn't want to sign traditional 10-year office leases, and they didn't want to work alone out of a coffee shop either. WeWork would rent large floors of office buildings, divide them into desks and private suites, decorate them with exposed brick and free beer on tap, and rent that space back out by the month. The company wasn't inventing shared office space. Executive suite providers had existed for decades before WeWork's first location opened. But it was rebranding the idea for a generation that wanted its workspace to feel like a lifestyle, not a line item. For the first few years, the model worked well enough to attract serious money. In December 2014, WeWork raised $355 million in a Series D round that valued the company at $5 billion, an already striking number for a company whose entire business, stripped down, was renting real estate at a markup. But the relationship that mattered more than any single funding round began in 2016, when Neumann met Masayoshi Son, the CEO of the Japanese conglomerate SoftBank. Son had a reputation for writing enormous checks based on conviction and long time horizons rather than conventional diligence, an approach that had already produced one of the most profitable venture bets in history, an early stake in Alibaba. The story that later became famous from Son and Neumann's first serious meeting captures exactly what kind of relationship this was going to be. According to an account later reported by Forbes, Son asked Neumann a direct question: in a fight, who wins, the smart guy or the crazy guy? Neumann answered, the crazy guy. Son agreed, then added a line that would look almost prophetic 4 years later. You are correct, but you are not crazy enough. That exchange happened not long after the two men had just finalized a deal valuing WeWork at $20 billion. Whatever else it reveals, it shows that WeWork's most important investor was explicitly rewarding audacity over caution at exactly the moment the company most needed the opposite. What followed was a run of fundraising that's almost hard to process in sequence. In March 2016, a $430 million round valued WeWork at $16 billion. By July 2017, a $760 million Series G pushed that to $20 billion, with the company crossing 200 locations worldwide. The following month, SoftBank's Vision Fund alone put in $4.4 billion. In November 2018, a warrant agreement with SoftBank implied a valuation of $42 billion. And in January 2019, a final SoftBank-led round brought the company's peak private valuation to $47 billion, with SoftBank's total investment across all of these rounds reaching roughly $10 billion. By any conventional measure of a real estate company, none of this made sense. WeWork didn't own most of the buildings it operated in. It didn't have a technology platform that scaled the way a software company does, where the cost of serving the millionth customer is close to zero. What it had was a story, that it wasn't a real estate company at all, but a technology-driven, space-as-a-service platform that happened to use office buildings the way Airbnb used spare bedrooms. Investors bought that story at a scale that, in hindsight, only makes sense if you understand what was happening underneath the pitch deck. It's also worth pausing on what raising around actually means here, because the mechanics matter for everything that follows. Each time WeWork raised money, the Series D, the Series G, the SoftBank rounds, it wasn't selling office space to pay for offices. It was selling a slice of company ownership to investors in exchange for cash the company could then spend however its leadership decided. That cash didn't sit in a bank account waiting to be needed. It went straight back out the door into signing new leases, opening new buildings, and hiring the staff to run them on the assumption that the next valuation jump would justify the last one. This is a completely normal way for a fast-growing startup to operate. What made it unusual at WeWork's scale was how directly that fundraising cycle was feeding a business with a real, physical, contractual liability attached to every dollar spent. A 15-year lease doesn't evaporate the way a marketing budget does if growth slows down. It's also worth noting what the company was spending its capital on besides new leases, because it tells you how far the "it's not really real estate" story had traveled inside the company itself. In 2017, WeWork invested $13 million into WaveGarden, a Spanish startup that builds artificial wave pools for surfing. A personal enthusiasm of Neumann's folded directly into the corporate balance sheet as though it were a natural extension of renting desks. The company also launched WeGrow, a private elementary school built around Neumann's own educational philosophy, and continued opening WeLive, a residential offshoot that applied the same co-working logic to apartments, letting tenants rent furnished rooms the way members rented desks. None of these ventures were fringe experiments run on the side with spare change. They were funded, staffed, and expanded, using the same capital and the same growth-first logic that was driving the core leasing business, at a moment when that core business had not yet proven it could turn a profit on the buildings it already had. Look at what that pattern tells you about how decisions were actually being made inside the company. A board, exercising normal oversight over a business burning through hundreds of millions of dollars a year, would typically ask hard questions before approving a multi-million-dollar stake in an artificial wave pool startup that has nothing to do with commercial leasing. At WeWork, that question either wasn't asked or wasn't asked by anyone with the power to stop it. And that's where the first real cause of WeWork's collapse begins, not in a side project, but in the fine print of every office lease the company signed, going back to that very first floor in Soho. Strip away the exposed brick and the kombucha taps, and WeWork's actual business was simple. It signed long leases with landlords, and it rented that space out on short terms to members. The company's own IPO filing, released to the public on August 14, 2019, put a number on exactly how mismatched those two timelines were. WeWork had committed to $47.2 billion in future lease obligations, payments it owed to landlords over the life of its leases, most of which ran 10 to 15 years. Against that, it had only around $4 billion in guaranteed future revenue from its own members, most of whom could walk away with 30 days' notice. Think about what that actually means in practice. If you sign a 15-year lease on a building, you are betting that you can keep that space profitably filled for 15 years straight. WeWork was making that bet across hundreds of buildings in dozens of cities, all at once, while promising its own customers the exact opposite: total flexibility, cancel any time, no long-term commitment. The company was borrowing long and lending short in real estate terms, one of the oldest, most well-understood ways a business can blow itself up, because it only works as long as new demand keeps flowing in, fast enough to cover the fixed cost sitting underneath it. One analyst, describing the arrangement to CNBC in the days after the S1 became public, put it in 5 words: that mismatch can be deadly in a recession. This wasn't a mistake anyone stumbled into. It was the deliberate architecture of the business, reinforced with every new building WeWork signed. And the obligations weren't shrinking as the company matured. They were accelerating. At the end of 2018, WeWork's future lease obligations stood at $34 billion. 6 months later, in the same S1 that revealed the $4 billion revenue backstop, that number had already climbed to $47.2 billion. In half a year, the company had added roughly $13 billion in future rent. It was obligated to pay landlords, all before it had proven it could turn a profit on the buildings it already had. To put that acceleration in perspective, $13 billion in 6 months is more future rent than most Fortune 500 companies commit to over their entire corporate history. And WeWork wasn't adding that obligation because demand had suddenly exploded and it needed the extra space to keep up. It was adding that obligation because signing new buildings was the fastest, most visible way to keep the growth numbers climbing ahead of the next fundraising round. The lease obligation wasn't a side effect of the strategy in a very real sense. It was the strategy, expressed in the one number landlords actually care about. And there's a version of this business that could have worked. Executive suite companies had rented offices on flexible terms to smaller tenants for decades before WeWork existed, without ending up $18 billion in debt. The difference wasn't the idea of subletting flexible office space. It was the speed and the scale at which WeWork chose to commit to that model, before it had proven the underlying occupancy and pricing could reliably cover fixed lease costs through an economic downturn. The exact scenario, a recession or a demand shock, that the CNBC-cited analyst had already flagged as the one moment this business could not survive. Here's the part that turned this from an aggressive but survivable strategy into a structural time bomb. WeWork wasn't slowing down to prove the model worked in a handful of cities first. It was racing to sign as many buildings as possible, in as many markets as possible, before anyone could measure whether the underlying unit economics actually held up. Because the company's valuation wasn't built on profit, WeWork had never turned one. It was built on growth, more cities, more square footage, more members, every metric that could plausibly justify a bigger number in the next funding round became the priority, and the lease obligations quietly piled up as the unavoidable cost of hitting those metrics. By the time WeWork tried to take that story to public markets in August 2019, the arithmetic was no longer avoidable. The prospectus disclosed a loss of $1.9 billion on $1.8 billion of revenue for all of 2018, meaning the company had lost more money than it brought in. And in just the first half of 2019, it had already lost $690 million on $1.5 billion in revenue. This was a company burning cash at a pace outside analysts estimated at somewhere between $150 and $200 million a month, sitting on tens of billions of dollars in future rent it had already promised to pay. That's the foundation the entire company was standing on, and it was built years before anyone had heard the word coronavirus. But the lease mismatch alone doesn't explain how a company got this far without anyone pulling the emergency brake. For that, you have to look at who was actually making the decisions and who wasn't checking them. Every company chasing hypergrowth eventually faces a choice: slow down and prove the model works, or keep raising money and keep expanding before anyone can check the math. WeWork chose the second path over and over for the better part of a decade, and the person making that choice with almost no internal resistance was Adam Neumann. By 2019, WeWork operated in a staggering number of markets simultaneously, Dozens of countries, hundreds of buildings, opened on overlapping timelines rather than sequenced to let any single market prove itself first. This is where the technology company story SoftBank and other investors had bought into did real damage because it changed what counted as success. A real estate company gets judged on occupancy rates and profit per building. A technology company gets judged on growth rate and total addressable market. WeWork's leadership consistently framed itself as the second kind of company to justify metrics that made sense only for the first kind of company to ignore. That framing wasn't free. It required capital, enormous, continuous capital, because growth at that pace doesn't pay for itself out of operating revenue when the operating revenue is already negative. Each new round of SoftBank funding didn't just support the existing business, it directly financed the next wave of expansion, which then required the next round of funding in a cycle with no natural stopping point, except a public market that would eventually demand to see profit or a private investor who finally said no. This is worth slowing down on because it's the engine driving everything else in this video. In a normal, profitable business, growth is self-funding past a certain point. The revenue from existing locations covers the cost of opening new ones, and the company only needs outside capital to accelerate, not to survive. WeWork never reached that point. Every single location it opened was, on the company's own disclosed numbers, losing money against the lease obligation attached to it, which meant every unit of growth had to be paid for with someone else's cash, rather than its own. That's not necessarily fatal for a young company still finding its footing. Plenty of now profitable businesses spent years unprofitable while they figured out their model. It becomes fatal when the company keeps scaling the unprofitable version of itself for years, because scaling multiplies the size of the eventual bill rather than the size of the eventual solution. For years, that investor never said no. Recall the exchange from Block 2. Masayoshi Son had told Neumann to his face that he wasn't crazy enough. That wasn't a passing remark. It was a description of how Son actually invested. SoftBank kept writing checks. The Vision Fund investment in 2017, the warrant deal in 2018 that valued WeWork at $42 billion, and the final push in January 2019 that took the number to $47 billion, applied to a company whose core business already had a structural mismatch baked into it. That philosophy didn't accelerate a sound strategy. It removed one of the only checks that might have forced Neumann to prove the underlying economics before signing the next 100 leases. And it wasn't just the pace of expansion that went unquestioned. It was the direction of it. The ventures introduced at the end of Block 2, the wave pool investment, We Grow, We Live, were symptoms of a deeper pattern. Capital and attention flowing toward whatever reinforced Neumann's vision of the company as a platform for how people live, learn, and even surf, rather than toward proving that the core leasing business could survive a downturn. Inside the company, these moves were defended as extensions of a coherent philosophy. From the outside, and increasingly from employees and board members as well, they looked like the kind of scope creep that happens when a founder has access to more capital than any check on his judgment. This is the second cause, and it compounds directly on the first. The lease versus membership mismatch from Block 3 was a structural flaw in the business model, survivable if tested carefully at a smaller scale. What turned it into a company-ending liability was the decision, made and remade at every funding round, to scale that flawed structure as fast and as far as possible, financed by an investor who explicitly wanted more audacity, not less. $47 billion in future lease obligations doesn't happen by accident. It happens when growth is the only metric anyone in the room is rewarded for hitting. It's also worth asking why nobody with real financial expertise inside WeWork's orbit pumped the brakes. The company employed experienced finance executives, and SoftBank itself is one of the largest and most sophisticated investment firms in the world. with teams of analysts capable of running exactly the kind of lease versus revenue math laid out in Block 3. The point isn't that the mismatch was invisible. It's that the incentive structure around the company rewarded ignoring it. Employees whose compensation was tied to the next valuation weren't rewarded for flagging balance sheet risk. Investors who had already marked up their stake in the last funding round weren't rewarded for questioning whether that markup was justified. The people most capable of catching the problem were, almost uniformly, the people with the least incentive to raise it. But even that doesn't fully explain how a company reached this point without its own board stepping in. For that, the story turns to what was happening in Adam Neumann's personal finances. Because as WeWork was racing to expand, its founder was quietly making sure he'd profit from that expansion, no matter what happened to the company itself. When WeWork filed its S-1 with the Securities and Exchange Commission on August 14, 2019, the document was supposed to be a sales pitch to public investors. Instead, it became one of the most damaging pieces of corporate disclosure in recent memory, because buried inside the required legal language was a picture of a founder who had spent years positioning himself to profit personally from the company he ran, regardless of whether that company ever turned a profit itself. The most direct example involved real estate. Adam Neumann personally owned stakes in at least 4 commercial properties. WeWork, the company he ran as CEO, then signed leases to rent space in those very buildings, paying rent that flowed, in part, directly to its own chief executive. Between 2016 and 2019, those arrangements paid Neumann roughly $20.9 million. He was in effect both the landlord and the tenant in some of his own company's most important real estate decisions, a conflict of interest that a company with a normal governance structure would typically prohibit, or at minimum require an independent board committee to review at arm's length. WeWork's board did not stop it. Then there was the trademark. Neumann and his co-founders had registered the name We, the same word the company was building its entire rebrand around, under a separate entity they personally owned. WeWork, the company, then paid that entity $5.9 million to license the rights to its own name. When this arrangement became public in the S-1 and drew immediate criticism, Neumann returned the money. But the fact that the deal existed at all and had to be undone under public pressure rather than caught and blocked internally says something specific about how decisions were being made at the top of the company before anyone outside was watching. None of this would have been possible without the voting structure Neumann had built for himself. WeWork used a dual-class share system. Ordinary shares carried 1 vote each, but the shares Neumann held carried 20 votes each. Picture what that ratio actually does. A group of shareholders could collectively own the overwhelming majority of the company's economic value and still lose every contested vote to Neumann alone because his voting power was structurally divorced from how much of the company he actually owned. This is a governance structure that exists, in theory, to let founders execute a long-term vision without being second-guessed by short-term market pressure every quarter. In practice at WeWork, it became the mechanism that let every other decision in this video happen without an effective internal check. The aggressive expansion in Block 4, the personal real estate deals, the trademark sale, the wave pool investment. None of it required convincing a majority of economic owners, because Neumann didn't need their votes to begin with. He needed his own. Compare that to how a normal public company board is supposed to function. Independent directors are meant to represent shareholders' interests, including the interest of not letting the CEO pay himself rent through a shell company he personally controls. WeWork's board included investors and allies who, structurally, had every reason to keep the growth story intact rather than interrupt it. When a board member's own fund has a rising valuation riding on the company's next round, that board member's incentive to challenge the CEO's related party transactions is, at best, complicated. The S-1 also revealed a corporate structure known as an UP-EC, a legal arrangement that gave pre-IPO executives, including Neumann, personal tax advantages tied to how the company was organized. advantages that would come, in part, at the expense of the public shareholders being asked to buy in once the company listed. And the board overseeing all of this was made up of 7 directors, every one of them a man, a detail that on its own says less about the collapse than it does about who was in the room, deciding whether any of these arrangements deserved scrutiny and who wasn't. Individually, any one of these disclosures might have been survivable, framed as an aggressive but explainable founder's quirk. Together, laid out in a single legal document that professional investors are trained to read line by line, they told a consistent story. The person running WeWork had spent years building mechanisms to extract personal value from the company and to insulate himself from being overruled while he did it. That story didn't just embarrass the company, it became the reason the IPO collapsed entirely. It's worth being precise about why public market investors reacted so differently than WeWork's private backers had. Private funding rounds are negotiated between a company and a small number of sophisticated investors who can extract concessions, demand board seats, or simply walk away if they don't like what they see, and who are often betting on the founder as much as the business. Public markets are different. Once a company lists, its shares are bought by pension funds, index funds, and individual investors who are relying on public disclosure rules to surface exactly this kind of related party risk before they buy in, not after. The S1 did its job. It surfaced the risk. What it revealed is that WeWork's internal decision-making had never been built to survive that level of scrutiny in the first place, because until August 2019, it had never had to. That's the third internal decision, after the lease structure and the growth at all costs financing, that made WeWork's failure close to inevitable long before any public health emergency entered the picture. What's left to explain is how a board and an investor with $10 billion on the line let all 3 of these problems compound, unchecked for years, and that failure of oversight is the fourth and final cause. By the time WeWork's S1 became public in August 2019, none of what it revealed should have been a surprise to the people closest to the company. The lease obligations had been growing on the balance sheet for years. The related party real estate deals were a matter of internal record. The dual-class voting structure had been in place since the company's earliest fundraising. What changed in August 2019 wasn't the underlying facts. It was that, for the first time, those facts were being read by public market investors and analysts who had no financial incentive to look away. That distinction matters because it points to the real fourth cause, a board and a lead investor who had every opportunity to enforce basic governance discipline earlier and chose not to because the growth story was working well enough to keep everyone paid. SoftBank had put roughly $10 billion into WeWork by early 2019. A $10 billion investor has enormous leverage to demand board seats, financial controls, and limits on related party transactions. Enforcing that leverage would have meant slowing down the very growth that justified the $47 billion valuation SoftBank itself had helped create just months earlier. So instead of a board acting as an internal check on the founder, WeWork had a board and a primary financial backer, functionally aligned with the founder's incentives. Keep the valuation climbing. Worry about the structural problems later. There's a broader pattern here that goes beyond WeWork specifically. When a single investor supplies most of a company's capital across multiple consecutive funding rounds, that investor's later rounds are, in part, protecting the value of its earlier rounds. Marking WeWork down or forcing governance changes that might slow its growth would have meant SoftBank admitting that its own prior investments had been mispriced. That's an uncomfortable position for any investor to voluntarily put itself in, and it's a structural reason, not just a personal one, why the check that should have caught these problems in 2017 or 2018 didn't actually arrive until public market scrutiny forced it in 2019. Later, arrived faster than anyone expected. Within weeks of the S1's release, the reaction from prospective public investors was severe enough that underwriters began quietly discussing a valuation far below the $47 billion private mark, eventually cratering toward roughly $10 billion, close to an 80% collapse in implied value before a single public share had traded. On September 17, 2019, WeWork formally withdrew its IPO filing. 1 week later, on September 24th, Adam Neumann stepped down as CEO under direct pressure from the board and from SoftBank, surrendering the majority voting control that his supervoting shares had guaranteed him for nearly a decade. Artie Minson and Sebastian Gunningham took over as co-CEOs, inheriting a company that had just publicly failed to go public. If you're following along and want to see how this story ends, including the numbers from the actual bankruptcy filing, which are more extreme than anything in the IPO prospectus, this is a good moment to subscribe, because Market Autopsy investigates one documented business collapse like this every week, built entirely from public filings and records, not speculation. The governance failure didn't end with Neumann's resignation either. SoftBank structured his exit with a package worth close to $1.7 billion. $970 million to buy back his remaining shares, a $185 million consulting fee, and a $500 million credit line to help him pay off personal loans he'd taken out against his WeWork stock, on top of $46 million a year in ongoing consulting payments. The founder, whose decisions had just cost the company its IPO and cratered its valuation by tens of billions of dollars, left with one of the largest exit packages in startup history. Weeks later, on November 6, 2019, SoftBank wrote down approximately $9.2 billion of its WeWork investment, about 90% of everything it had put in. The company limped forward. It went public via a SPAC merger in October 2021 at a valuation of $9 billion, a fraction of its 2019 peak, and spent the next 2 years trying to prove the underlying business could still work under new leadership. Then, the specific event this video's title refers to arrived, and it wasn't a lockdown order. By the summer of 2023, WeWork's occupancy had actually recovered. In August 2022, physical occupancy across its buildings hit 72%, back to pre-pandemic levels. By the second quarter of 2023, the company reported consolidated revenue of $844 million, up 4% year-over-year, and a net loss of $397 million, an improvement of $238 million compared to the same quarter the year before. It reported 512,000 consolidated physical memberships, and its lighter-weight all-access membership product, which lets members use any WeWork location rather than committing to one, had grown 21% year-over-year to 75,000 members. On paper, that's a company healing the pandemic-era damage to office demand. The thing most people blame for WeWork's death was measurably behind it. And yet, in that same quarterly filing, WeWork disclosed something the numbers above don't capture: current lease obligations of $883 million and long-term lease obligations of $13.28 billion. The same structural mismatch from Block 3, still sitting on the balance sheet, still larger than the company's ability to cover it, 4 years after the S1 first exposed it, and nearly 2 years after occupancy had recovered. Recovering from the pandemic didn't fix WeWork's business model, because the pandemic was never the thing that was broken. This is the detail that undercuts the easy explanation more than any other single fact in this story. If the pandemic were truly the root cause, then a return to 72% occupancy, roughly matching pre-pandemic levels, should have put WeWork back on stable footing. It didn't. Revenue was growing, losses were shrinking, membership was recovering, and the company was still, by its own admission, staring down $13 billion in long-term obligations it had no clear path to covering. The pandemic had been a severe, painful disruption to WeWork's day-to-day business. It was never the reason the underlying business was fragile in the first place, and the going concern warning that followed proves it. That warning came after the recovery, not during the depths of the lockdowns. On August 8, 2023, the company filed a formal disclosure stating there was substantial doubt about its ability to continue as a going concern. The plainest, most legally serious warning a public company can issue about its own survival. 1 month later, on September 6, 2023, WeWork announced it would attempt to renegotiate nearly all of its leases and exit its worst-performing locations. A last attempt to undo, one contract at a time, the exact imbalance its founders had built into the company from its very first lease in Soho 12 years earlier. It didn't work fast enough. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy protection in federal court in New Jersey. The filing listed liabilities in the range of $10 to $50 billion against its declared assets, with more specific figures cited elsewhere in the case, putting total debt at approximately $18.6 billion against roughly $15 billion in assets, a company that owed more than everything it owned combined. WeWork's stock, which had once been projected to make Adam Neumann one of the richest self-made entrepreneurs in the country, closed at 84 cents a share. The company's total remaining market value, $44.5 million, $47 billion to $44 million. Not a decline, a collapse of more than 99.9% of the company's peak value, achieved over 4 years in which the obvious cause, the pandemic, had already come and largely gone. What actually connects the beginning of this story to the end of it isn't a virus. It's a lease signed in 2011 that promised more than the business could ever guarantee, a growth strategy in 2017 and 2018 that scaled that promise instead of fixing it, a founder in 2019 who was caught extracting personal value from the wreckage before anyone outside the company knew to look, and a board that, for nearly a decade, never once said no. Every one of those 4 causes was individually survivable. Plenty of companies carry lease risk. Plenty of startups chase growth harder than their fundamentals justify. Plenty of founders have conflicts of interest that get managed, disclosed, and contained without destroying the company. Plenty of boards are less aggressive than they should be. WeWork is the case study. It is not because any single one of these 4 failures was unique, but because all 4 were present at once, compounding each other for the better part of a decade, inside a business that had razor-thin margin for error to begin with. WeWork emerged from Chapter 11 bankruptcy on May 30, 2024. The restructuring eliminated $4 billion in debt and canceled or renegotiated hundreds of leases, the same leases that had sat on the balance sheet as the company's core liability since the very first S1 in 2019. Ownership of the reorganized company shifted almost entirely away from the people who had built it. Yardi Systems, a real estate software company that had financed the bankruptcy process, took 60% of the new WeWork. Hedge funds that had bought up the company's distressed debt took another 20%. The founders who built the $47 billion story were no longer meaningfully part of the company that still carried their name. Adam Neumann, for his part, didn't disappear from the industry. He'd just spent a decade destabilizing. In August 2022, the venture capital firm Andreessen Horowitz backed his next real estate venture, called Flow, with one of the largest single checks the firm had ever written for a startup, reportedly documented at roughly $350 million. Flow has since been valued at over $2 billion, built around residential real estate rather than office space, and publicly framed by Neumann as an attempt to apply the lessons of WeWork's failure to a new model. Whether that framing holds up is a story for a different video. What's already documented is that the founder whose personal decisions sit at the center of 3 of this video's 4 causes left WeWork with roughly $1.7 billion in exit compensation, and within 3 years had a new venture backed by one of Silicon Valley's most prominent firms, while WeWork itself went through bankruptcy, and the employees, landlords, and members who depended on it absorbed the actual cost of those decisions. The lesson underneath WeWork's collapse isn't really about co-working spaces or even about real estate. It's about what happens when a company's growth metrics and its founders' personal incentives are allowed to point in the same direction, unchecked for long enough that a structural flaw in the business model, the mismatch between long leases and short memberships, has years to compound instead of getting caught and corrected early. A dual-class share structure that hands one person 20 votes for every one vote held by everyone else isn't just a governance footnote. It's the mechanism that determines whether anyone in the room has the power to say no when the numbers stop making sense. At WeWork, for nearly a decade, no one did, because the one person with the power to say no was the same person the growth story was making richer. This is also why the pandemic explanation has proven so durable, even though it doesn't hold up against the company's own filings. It's a satisfying story because it removes anyone from blame. Nobody chose the pandemic. Nobody can be held responsible for a global health emergency. Blaming the virus lets the growth at all costs financing, the self-dealing, and the governance failures documented across 4 years of public filings quietly disappear from the narrative, replaced by an act of nature nobody could have prevented. The documents tell a different story, one with names, dates, and decisions attached to every stage of the collapse. Go back to the number this video opened with, $47 billion in January of 2019 for a company that rented desks. That number was never a measure of what WeWork's underlying business was actually worth. It was a measure of how long a flawed structure can keep expanding before the bill comes due, and of how much room a founder with total voting control has to extract value from that structure before anyone with the power to stop him decides to try. The pandemic didn't write that bill. It just happened to arrive around the same time it finally came. If you want the documented decision-by-decision breakdown of the next company that looked unstoppable right up until it wasn't, subscribe to Market Autopsy. Every video here is built the same way this one was. Public filings, dated numbers, and the internal decisions that get left out of the easy explanation.